All right, Money Miners, we've got a pretty exciting chat to give you today. A few weeks ago, we started talking about the topics of diamonds, and we said we'd get on somebody that knew an awful lot more about the space than ourselves, and we've done so. We've got Paul Zimnisky here with us, the expert, the go-to consultant for the diamond space. So thanks, Paul, for making the time and coming on Money of Mine.
Yeah, thanks for the invite. I love the show.
So I thought the kind of cool spot to start this conversation is the highs and lows and a brief sort of history of the diamond market. It's such a fascinating commodity. There's so many, unique parts of the history relative to other commodities. So yeah, I thought a cool place, Paul, would be if you could give us a bit of an update or background that kind of brings us to the present day, and we can kind of go from there talking about lab-grown diamonds and everything and the unique point in time that we're now in.
We'll preface it, we know very little other than the fact that De Beers literally had a monopoly. Like, when does that ever happen in commodity markets that, one single company has a monopoly? But would love your insights.
Yeah, I mean, so the history is quite interesting. Like you probably read in your uni textbooks, what was a monopoly that was dismantled probably between 2000 and 2005. So, where we are today, it's still, I would say, like an oligopoly. If we look at, say, De Beers and the Russians, they combined, produce, upwards of 2/3 of global supply. So the industry structure, at least upstream, is very concentrated in that way. I guess if we just look at, the way the industry, looks at pricing today, the major producers like De Beers and the Russians, they typically sell via contract. And I would say it's maybe, similar to the way that, say, the potash market operates, or the uranium market, these kind of more unique, mining industries. I think what makes diamonds even more complicated is it's a non-fungible asset. You buy oil by the barrel, you sell, gold by the ounce. With diamonds, you literally have 10, 20,000 different categories because you have all these different sizes, these different qualities, different shapes, different colors, different clarities. The list goes on, and it kind of makes the pricing dynamic a lot more complicated. And what you see in the trade, if you're a mining company, you're selling rough diamonds, you're selling to a cutter and polisher and manufacturer. They're probably in India. And all these, manufacturers, there's probably, 10,000 of them. And they all specialize in certain, categories of diamond, and they want consistent supply of those certain categories. And that's kind of like maybe the backbone as to why, the major diamond miners sell diamonds the way they do via contract, because they basically take all their supply, they kind of aggregate it based on the certain categories, and then they sell it to the customer that ultimately wants those categories. So the manufacturer wants consistent supply, and then what say De Beers and Rosa get. Rosa is the major Russian miner. They essentially get to set the price, and over time there's been relationships that have built, and these manufacturers are essentially comfortable paying the price that the mining company sets. So when I talk about contract, selling that's basically what I'm talking about. Now the other, say, third of the market is more independent, smaller producers, and they're going to sell either via contract. They're going to sell either via auction or tender, or maybe they have a key investor and there's an offtake. So that's kind of the way the market works. At the end of the day, I think the prices ultimately do certainly reflect what's going on in the market. But given that the bulk of diamonds are priced via contract, there's probably less volatility in prices, at least historically, because of that. But when demand's down, the miners will hold back supply, or they'll adjust prices and try to allow their customers to kind of regain profitability. So I mean, there are the typical market dynamics in play, but it's certainly a little bit different because of the way that most are sold via contract.
So if we tap into the history a bit more to understand the present, is it right in my thinking that it was really the discovery of the Canadian mines mixed with Argyle and Rio Tinto, as well as Alrosa coming into the market throughout the 90s, that ultimately led to the breakup in the monopoly of De Beers, or is it a bit different in your view?
No, I think that was, it was multivariate. There were a few factors. I think the big ones though was like it was antitrust legislation in the U.S. And in Europe. So I think that was kind of the major catalyst. And again, it kind of happened over time. It took, I would say a good 4 or 5 years. But by the time De Beers basically sold off their strategic stockpile. But I think when we look at industry fundamentals, over the last 25 years, I think front and center is the industry still kind of trying to find its footing, following that major structural change, kind of going from a monopoly to more of an oligopoly, and there's more competitors in the market. There's more pricing dynamics at play. The industry was probably a better industry for the participants when it was a monopoly, right? So, that's kind of been kind of the big change, and it's kind of the elephant in the room that people don't really seem to acknowledge. But I think the industry is still kind of trying to digest that change.
So now you've got the presence of the lab grown makers. To start with, who really drove that? Who were the big companies that are now the big players in the lab-grown diamond space?
Yeah, so that's a interesting background there as well. So I mean, we've been producing synthetic or manufactured diamond for since probably the 1950s. We've had the technology. Probably 95% of diamonds used for, say, industrial abrasive application. If you have a certain piece of construction equipment or specialty tool that cuts airplane windows, or you just buy a tile a tile blade, saw blade for cutting bathroom tile at home. I mean, that's all going to have diamond in it, but the very large majority of that is synthetically produced. It's produced in China. And to kind of just give you some context on the volumes produced, so say there'll be just roughly 100 million carats of natural diamonds produced this year. They'll produce 10 billion carats of synthetic diamond for abrasive application. Wow. So it really kind of highlights, the manufactured versus the natural, and what the supply could look like.
Wow. So 100x the volume.
Right. I mean, theoretically, you can produce as much as you want, like you could with any manufactured product. Now,
and that comes in lower in the cost curve, right? It's like way cheaper to produce these synthetic diamonds.
Right. It's a function of economies of scale and just continued advancements in technology.
Sound like cross-boundary energy to you, Trav?
It absolutely does, mate.
Right. Well, you think of their continued advancements in optimizing hybrid power stations for our great mining industry.
The technological advancements of what's happening in power and how these mine sites are powered, mate, is
phenomenal.
It's comparable to like the development of lab-grown diamonds.
It is. Well, you think of from the CBE side, they can't optimise any more than zero capex. No. You can't go lower than zero unless they just start giving you money. They can't optimise any more the fact that they build the whole hybrid power station.
Yep.
And they can't optimise any more the fact that they operate it all, like fully optimised. But they are continuously optimising how good these hybrid power stations are. Mate, they are that bloody good. They're better than sliced bread.
It's elite. It's on a silver platter. It's like the perfect model, perfect solution to power your mine site in the most optimal, technologically advanced way. Get in touch with Tim Taylor.
Mate, make your day perfect and call Tim Taylor and Cross Boundary Energy. Mate, diesel, gas, wind, solar, batteries, all into the one power board. Sorted.
But there really wasn't a whole lot of like jewelry manufactured diamond on the market. It wasn't until maybe 2015 that technology really ramped up and investment was spent on R&D. And I think there's a few reasons for that. If you look at like the LED light bulb industry, they use this technology called chemical vapor deposition that was also used to produce polysilicon for solar panels when we had the solar boom in say like the early 2000s. There were people that kind of leveraged that advancements in that chemical vapor deposition technology and kind of used it to, produce diamonds more efficiently and produce better qualities. So that was kind of one of the factors. But at the end of the day, it was basically advancements and production technologies. More money was spent in R&D. And we went from a situation in, say 2015 where, you could buy a jewelry quality man-made diamond, but it was maybe only 10 or 15% less in price than an equivalent natural diamond. And you kind of fast forward to today and, production's just ramped up like significantly. It's when, hyperbolic technologies have continued to improve. The economies of scale have improved significantly for the major producers, and we're now at a situation where you could buy, a man-made diamond for, just a fraction, 10, 20% the price of an equivalent natural diamond. So, I mean, that's happened over a relatively short period of time. It was, less than 10 years. So, I mean, that's certainly something else the industry's, digesting. I think that the key there is that you can distinguish between a man-made and a natural diamond. And that's obviously why that pricing differential is so significant.
What is the practical realities of differentiating between the two?
I mean, so sometimes you could do it with the naked eye, but most of the time you need a professional gemologist. They have equipment. They use fluorescence and photofluorescence. It has to do with the impurities. So diamonds, it's not an element, it's a mineral. And there's impurities that they could trace to distinguish. Sometimes you can see actual growth lines.
Gotcha.
In a manufactured diamond. So they do have ways to do it, but typically you're going to want to use a professional, a gem lab to do that for you.
Because it's like diamonds. It was a market where you had super margins because you could control the quantity, and they were marketed as a luxury product. Luxury products have super margins. Like it's just one of those wonderful phenomenons. But if you have the ability to produce an equivalent thing that isn't distinguishable from the naked eye, it's kind of like, you can kind of tell a counterfeit handbag, for example, but can you tell a lab grown diamond from the naked eye? I don't think so. Like, it's fascinating. It's fascinating, right? Because the consumer preferences might not, in many cases, might actually just have an incentive to purchase these lab grown rocks as a substitute for a proper rock.
Yeah, I mean, that's certainly part of the way you have to think about this. I mean, I would say that there are handbags and there are watches that are so good you probably can't distinguish. I mean, when you look at really high-end art, I mean, there's definitely, counterfeit artists that can do an amazing job that will still get sold at auction as an original when they are. But I mean, the point being is, that, if we're talking about industrial diamonds, the consumer doesn't care if it's man-made or natural. They just want the lowest price, best performing option. I think when it comes to jewelry, it's definitely a luxury product. It's an emotional purchase. People buy it because it makes them feel good. It's a statement gift. It's more complicated because it's a luxury product, and ultimately that's what's going to probably be the saving grace for the natural diamond industry. I mean, if you create the desire and you market it properly, you could argue that some people feel there's a stigma, around a man-made diamond versus a natural. It's not a practical purchase for most people, and I think that's kind of the key to understanding this. And at the end of the day, it's up to the natural diamond industry to convince consumers to pay multiples more for a natural diamond that was naturally occurring. That's a billion, 2 billion years old. And just historically, like humans, we've valued rare and precious materials, and it's not always practical. I mean, I guess you could make a beautiful ring out of aluminum. I mean, I would argue aluminum's could arguably be a superior material to gold. I mean, but we use platinum, we use gold, we use silver. People want jewelry that's composed of rare and valuable materials, and that's kind of what makes it special. You can't have as much as you want. It kind of retains value because of that. But I mean, there's a lot of complexities at play here, and that's, I think, what makes it so fun to analyze, actually.
So one of the things I found so fascinating about some of the podcast interviews you've done with the various guests you've had is the differing views that they had, from extremely bullish on the future of lab-grown diamonds to the opposite of that, and extremely bullish on the future of the mined diamond, given exactly what you're talking about there, that the marketing will break through and the narrative behind selling the product that they sell will break through. Do you have a strong view either way on the future? Do you think it'll be a balance? Do you think the mining companies are in for a rough time?
I think almost all of this hinges on whether or not the natural diamond industry can market its product efficiently, effectively, and aggressively enough. And I mean, everybody's probably familiar with the De Beers, the Diamond is Forever campaign. I mean, it's probably the most famous, consumer product marketing campaign, of the last, 50 to 100 years. I mean, it's up there with the greatest of all time. And De Beers used to spend, this is just based on my own, estimates. It's kind of hard to come to a precise figure here, but I think they were probably spending $400 to $450 million a year in inflation adjusted dollars if we look at 2024 dollars. And now the natural diamond industry is probably spending under 100 million a year, right? So
do you have a gauge of what portion of their top line that was, or?
No, I don't have that number, but it's significant. And I mean, you'll see that across the luxury space. And if you look at, someone like Tiffany, it was acquired by LVMH a few years back, but when they were public, they would publish their, annual marketing spend, and they were spending like, $300-400 million a year. I mean, it kind of comes with the territory with the luxury product. And the challenge is it's like you don't get immediate payback on that, right? So if you start spending $300-400 million a year, you start a new brand. I mean, it could take years or decades to get to the point where you can kind of really have a globally well-known premium brand that people are willing to pay a big premium for. So historically, the key was to kind of be very consistent with the marketing spend, and then over time you kind of build some real momentum, and that's I think why diamonds are still as relevant as they are today, even though the industry doesn't spend nearly what it used to. There was just so much momentum, built up over decades and decades of spending all that money. But I think we're getting to a point now where younger, consumers and just younger generations don't perceive diamonds the same way as kind of their parents or their grandparents did, because they really weren't exposed to that same campaign. So to me, I think about this all the time, obviously, and I think marketing really is the key here. You got to look at it as a luxury product first and foremost. If you're a copper producer, it's like you need an infrastructure project in China, or the Green New Deal in America, infrastructure build out project. But with diamond, you have to produce the product, but you have to create the demand as well.
That's so
kind
interesting.
of always always what's made it unique.
It's the only mining company or commodity that is mined where the mining companies are expected to actually market the revenue growth, market convince customers to actually pay more for the product. I mean, you're a price taker in every market as a commodity producer, but marketing can actually change that, and historically has changed that for the diamond industry, which is like such an exception.
Which is a positive and a negative, right?
Yes.
I mean, it's positive that it's kind of in your control, but it's a negative in that you have to spend a lot of money to market your product. And if you kind of lose, track of that, the industry can get, can certainly get in a rough patch. And I mean, I would argue that that's part of the reason why the industry is, kind of going through a rough patch at the moment. So
the prices are bifurcated. If we focus on the mining companies right now, with the sector pretty beaten up, do you have a rough indication of how many mines out there, or a proportion, are making money at these sort of prices? Is it a handful of them? Is it a larger portion of all the mines in operation?
Yeah, so let me just give you kind of the background, how we got to where we are, say, today, if we're just looking at the short term. So we had, obviously the lockdowns in 2020. Nobody can kind of go out. Nobody could basically do anything. Businesses were shut. So that was, huge recession for the industry. Then, say in the U.S., there was $7 trillion of consumer stimulus that was distributed. Everybody was still locked down. They couldn't go out, and they couldn't go out to dinner, and they couldn't do entertainment. And people stayed home and they shopped and they spent money. And I think diamonds did particularly well because people were, giving, say more special gifts to fewer people. They're kind of locked in with their families, so they were buying nicer things. Diamonds do well in a situation like that. So we went from, a horrible year in 2020 to an incredibly good year in 2021, and that kind of followed into early 2022. the supply chain literally like ran out of stock. Like they ran out of diamonds, and then the supply chain aggressively started to restock inventory, kind of in 2022 into 2023, and that's kind of when the demand factors kind of flipped. The stimulus had run out. People kind of could kind of go out and travel again, and they can kind of do outside entertainment. They can go dining, and they bought enough diamonds, in 2021 and 2022. So we kind of had, demand kind of came in significantly off of that bubble, if you will. And then the industry was aggressively restocking. So, before you know it, the supply chain was overstocked. And that's kind of what's been putting pressure on prices since. So there's just been historic volatility, in the trade over the last, 3-4 years. And then as far as, what mining companies are doing well, I mean, it's definitely difficult across the board. And there's been, producer cost inflation as you've seen across the mining complex. So, you have gold at an all-time high, and diamonds are, down 25% from, their high end, 20, say the first quarter of 2022. So you kind of have, the opposite thing happening for the diamond miners, and it's been difficult. I think they do, what they can to try to, temporarily reduce costs and kind of maybe, cut down production a little bit. But it's definitely been a rough patch for the diamond mining companies over the last 2 years.
And to quickly check in on the lab-grown diamond makers, are they making money at these prices? Is their profitability relative to the miners much different?
It's still a novel industry, and the price of lab diamonds has fallen a lot more precipitously than natural diamonds, just because the production has gone parabolic. So I think what you have with the lab diamond producers is you're going to have a small handful of very large companies and say low cost, production jurisdictions like India and China that are going to continue to ramp up production and, benefit from economies of scale. And then you have maybe some of the more, say, tech or Silicon Valley like startup companies in the Western world that are going to have more difficulty, kind of competing with the Indians and the Chinese on price as, volumes spike.
Sounds pretty similar to what K-Drill are going to do to the exploration drilling industry, I think.
K-Drill, mate, they find gold, they find silver, they find lithium, they find
metal.
They find metal, they find iron ore, they find diamonds.
They could find diamonds. Needle in a haystack, they'll find it. Because everyone's going to struggle to compete with them once they take over the RC and diamond drilling industry. I see them having parallels to Nike and Michael Jordan.
Tell me.
So Phil Knight and Nike identified Michael Jordan as the next biggest thing. They got him young. They got him early. I would recommend mining companies, be Phil Knight, get K-Drill early before you miss your chance. They're honestly, like, if you combine Ryan O'Sullivan and Drew Harvey, they are essentially Michael Jordan at North Carolina. I'm going to actually say it different. I think if you combine Michael Jordan and LeBron James, that gives you Ryan O'Sullivan.
Yeah. I reckon there's a little bit of Dennis Rodman in that joy too.
Oh, very much so. Very much so. Look, miners, you got to see what I mean. When you get them tendering on an RC or diamond exploration or infill drilling contract, you'll know where I'm coming from when I'm talking superstars.
So I think you're going to see a situation where maybe some of the more, specialized lab diamond producers in the West start to focus on other applications outside of jewelry for their diamonds, like high-tech applications. Diamond has all these amazing potential for application and, computing technologies, heat sinks in electric vehicles, and even, nuclear battery storage, that sort of thing, lasers, optics, list goes on. But I think for a lot of these high-tech, applications, the price of the raw material is still a little bit too high. So they're going to have to kind of, come up with ways to get the price to come down even further. So I think you're going to start to see those more specialized producers kind of maybe focus less on the jewelry market, and you're going to see these large volume, mass producers in China and India focus more on the jewelry market. And I think that's kind of what the market's going to look like. But there's certainly been a shakeout of lab diamond producers over the last, just couple of years.
There's two things that like stick with me whenever I think about the like diamond market history. One is that it wasn't until the mid 50s that, it even became mainstream that, getting married or proposing actually involved a diamond engagement ring. Like that wasn't the norm at all until marketing. And then the other one is the fact that so 60% of Botswana's GDP is revenue from the diamond industry. That's kind of crazy. So like, what's that kind of political dynamic like with Botswana at the moment, given the pressure the diamond industry's been, and the diamond miners in particular have been under?
Yeah, so Botswana very unique in that way. It's almost like some of the Middle East oil producers. I mean, they just have so much exposure to the one commodity. I mean, you could argue that Botswana's did a very good job, with revenues from diamonds. They have, public education, public health care. It's a very small nation of 2 million people, but it's it's a very young country. They're very proud people. You go to the capital Gaborone, there's some pretty serious infrastructure being built. You kind of have this new emerging city there, and most of it's been built on diamonds, so it's kind of unique in that way. Botswana is kind of known for being one of the least corrupt countries in Africa, so they've done a pretty good job. But they have so much sensitivity to diamonds. So when you go through a downturn like we are now, it's directly kind of felt within their economy. And I think I think they elected a new president because they want to change. There's some people that are arguing that the previous president was too hardline. He was basically negotiating with De Beers in a way that was a little bit too hardline, and they feel they need to maybe be open up to I guess maybe more accommodative negotiations with De Beers. So Botswana has a big joint venture with De Beers, and all of their mines but one are part of the De Beers joint venture, and they have a marketing and a sales agreement that they've been trying to renew for over 3 years now. So that's kind of been going on. So I think that's kind of front and center for most people there, and they just maybe feel that the previous president wasn't able to get that done. So the new president has been very clear that that's going to be a priority, and he's going to do things a little bit differently. So, that's kind of what's going on there now. But I think longer term, I think they're looking for ways to diversify away from diamonds, which is probably the right thing to do. Again, you've seen that in the Middle East. You look at kind of what's going on in the UAE, and they've done a very good job of coming up with ways to kind of diversify away from, oil and gas industry, and they're kind of, looking for ways to stimulate international business outside of oil and gas. And Dubai has actually become one of the largest diamond hubs in the world, and that was just an industry they had no exposure to previously. So I think Botswana is looking to do the same, but I mean it's hard, it's difficult, it's complex, and it takes time. But they have a tremendous amount of exposure to diamonds, probably too much.
All the while, Anglo American is in the midst of trying to rationalize its De Beers interest with a sale process penned for sometime next year, mid to late next year. What's realistically, like what kind of environment would it look like for Botswana have to okay that? Is what probability can they actually get like a decent value for that business, just given how kind of under pressure the entire diamond industry is?
Yeah, and I mean, not only is it under right, I mean, it's not only under pressure right now, it's just it's a very, very complex business because of everything we were talking about before. It's not just a mining business. You have to market the product as well. They're basically a vertically integrated business, and then you have all the complexities with the joint ventures. Botswana is the most notable joint venture. So it's a very unique business. There's not a whole lot of comps. I mean, Wall Street always wants a comparison, but there's really no comparison. There's nothing else like it. And then in addition to that, again, the industry's in a downturn right now. So I think it is a difficult time to be, selling off that business. I think if you look at, what Anglo is doing, I think they're kind of focusing on divesting the platinum and the met coal business first, and then they're going to get to De Beers, and they're saying that's probably going to, be sometime next year. I mean, we'll see. I mean, I think as an Anglo shareholder, I think there is a price threshold that you probably would be willing to accept. I mean, I don't think you want to just sell it off at all costs. I think if you feel that you get a fair price, you divest it, and it kind of, it cleans up the company for the way you want it to look going forward. But again, given all those factors we were talking about. I mean, maybe Anglo ends up just holding on to it. I don't know. They've, 10 years ago when they were doing that big strategic, divestiture play, they actually ended up holding on to some of the assets. I don't know. They make it very clear. They said we are not going to do that. But again, I think if they can't get what they think is a fair price, maybe that is a possibility. I guess the other possibilities are just, spinning it out, IPOing it. I think, just someone that covers the industry, the one thing I don't want to see is just a value buyer kind of come in and scoop it up and just try to, bleed it dry and just, make some money in the short term and kind of leave it to die and rot. I think, it's a business that actually needs to be coddled right now. I think you need someone that wants to invest longer term, in the business and someone that believes that there still is, years of good growth ahead. And I think there is. I mean, it's been an extremely resilient industry. De Beers has been an extremely resilient company, and I think there's a reason for that. I think there's something special and unique about the business, and I think if you kind of invest in it the way that you need to, I think there certainly are some good years ahead. So that's kind of the way I'm looking at it right now. But it's a tough one. It's a really difficult one to analyze. The valuations are all over the place. It's going to be interesting to see how it plays out.
Who's a buyer as well? Like, there's no obvious buyer.
Yeah, maybe a consortium. I mean, maybe, who knows? I mean, it seems like most of the luxury houses are acknowledging that it's difficult to run a mining business, right? Like they can handle the downstream and probably do quite well with it. And then with, other, mining majors, obviously like, BHP, Rio, has a history of being in the business. They haven't really indicated interest in it, but, they know how to run the upstream side, but not necessarily the downstream side. And again, that's kind of what's historically made this, such I think a difficult business to kind of value and sell.
You need a mining billionaire that loves diamonds.
I can solve for the first part here. We'll sort of see on the sort of topic of the big players in the market. I'd love to chat a bit more about Alrosa and just learn a bit about them. I mean, it stood out that they sort of diversified not too long ago and bought a gold miner. What did you make of the sort of decision to buy Polyus and the decision to diversify the business somewhat?
Yeah, so if you go back and look at the history of De Beers during the global financial crisis of 2008, 2009, they acquired a natural gas and an iron ore asset. So they have done that in the past. I think they made money on one of those assets. I don't remember which one. So, I mean, they have done that sort of thing in the past. But when you look at the amount of money they spent on that asset, it's still just a fraction of what they spend to run the diamond mining business. It's definitely still a diamond mining business, first and foremost. I think when you look at the way that the Russians look at it, it's probably, literally a low single digit percentage, if we're looking at the revenue it generates compared to, say, oil and gas. So it's still kind of small niche business for them if we're just looking from a national standpoint. So I mean, I think they'll continue to carry on. I mean, it's interesting because, I mean, it is a public company. It's only listed in Moscow. But they really, I would say, between, 2010 and 2022, they actually became a very transparent company. They would do, analyst days, capital market days. They would have, quarterly reporting that was very transparent. They would, publish, the results of their monthly sales. I mean, it was really interesting because it went from, a company that was very opaque to arguably the most transparent company in the industry, and now it's completely, opaque again. It's like the veil's been shuttered. So, I mean, we'll see. I mean, as an analyst for the trade, I mean, I think the industry's better when kind of everybody's kind of working together and talking and cordial with one another. But it's definitely different now. Post 2022 and all the sanctions and. They don't really, publicize anything anymore. So, I mean, we'll see, see how that plays out. But, there's just been volatility across the industry in so many different areas just the last 4 or 5 years. I mean, it's been nonstop.
Yeah. like if you were to just kind of guess yourself, Paul, I mean, you speak to people in the industry all the time. Yourself, an analyst that follows it like super damn closely. Do you think mine diamond prices like 10 years from now is higher or lower than it is today?
I think it's a direct function of how much they spend on marketing. And it seems like the industry is starting to really acknowledge this and take this seriously. De Beers just cut a cooperative agreement with the 3 largest strollers in the 3 largest markets in the US, India, China, to basically come in and actually work with their frontline salespeople and kind of train them how to properly sell a natural diamond and how to explain to a consumer why they might want a natural diamond over a lab diamond. The Natural Diamond Council, which is kind of the new version of a Diamond is Forever campaign. It was basically set up so all of the major mining companies can kind of cooperate and kind of work together and try to re-stimulate generic marketing. They're doing a good job. I think they need significantly more capital. So the industry acknowledges how important marketing is. Everybody that's been in the trade, knows the history of how important marketing is. And that's just going to end up, being the key, I think, going forward as well. So again, it's up to the natural diamond industry to convince consumers to pay, 5, 6, 7, 10 times more for a natural diamond. And if they're successful doing that, as they have been in the past, I think the natural diamond industry is going to be fine. That's going to be the key. I mean, the industry is so unique in that. I mean, you go back to the pre-1990s. Japan didn't buy any diamond, or I'm sorry, China didn't buy any diamonds, and now they're the second largest consumer of diamonds in the world. If you go back to, it was probably the 70s and the 80s, the Japanese didn't buy any diamonds, and De Beers went in there and they marketed aggressively, and at the time, Japan grew to the second largest consumer of diamonds. So again, it's a very unique industry in that way. If you kind of spend the money and direct the resources appropriately, you could create, brand new incremental demand. And again, that's kind of what's made this industry historically so interesting. The fast growing net market now is the Indian consumer market. Given the slowdown in China right now, just within the last probably year or so, India's probably overtaken China as the second largest consumer of diamonds in the world. The industry seems to be kind of targeting a lot of marketing to the Indian consumer market. And that's, you're already starting to see that reflected. But it's a very interesting industry in that the US is probably 55% of global diamond demand is in the US alone. So it's very concentrated between, I'd say, the top 3 markets when we're looking at demand. And that's just because the industry, I think, targets those 3 markets and spends, all their money marketing in those particular markets.
Just on the supply side, a number of the big operations have shut down over the past 5 or so years. And my understanding is you've maybe got one big operation coming on in the next few years. Is that sort of broadly right? Do you see the actual mine supply trailing off a bit?
Right. So there's been a trend over the last, probably 20 years of just major, mines reaching depletion. I mean, obviously the Argyle mine, in Australia, reached depletion at the end of 2020. I mean, there was at one point in time, from a volume standpoint, that Argyle produced 40% of all diamonds globally. That was in the 80s. So just kind of give you some context there. But I mean, there's a couple of reasons for this. I mean, diamonds, they are rare, contrary to what, you may read in some media articles. At least large economic diamond deposits are extremely rare. So that's part of it. And then, I mean, diamond prices just have been, relatively flat over the last, 10 years. There's been, obviously significant volatility the last 2-3 years. But there just hasn't been a significant amount of money spent on, new exploration and development. So it's just a combination of less money being spent and just a lot less, assets. The big assets have been discovered, they've been exploited and produced, and some of those are at the end of their mine life. So that's kind of been the supply trend. I mean, the supply trend in this industry is quite good. It's quite bullish. I think if you were just to kind of look at some of the numbers, so that kind of takes us back to demand. And it's like if the industry can be successful in driving demand, I think the supply fundamentals are going to be supportive of higher prices. So to me, right now, it's all about demand. The supply is not an issue. The supply is favorable. I would argue.
Beautiful. I've just got one more for you, Paul. Are there any sort of views that you hold relative to the other people that watch the industry as close as you do that stand out as being pretty contrarian?
I mean, so the diamond industry is unique in that, especially when we're talking about the midstream, the manufacturers, the cutters and polishers, they're very pessimistic by nature. A lot of them are Indian. I don't know if that's kind of just in the culture. I guess in that standpoint, the contrarian view would be that the world's not going to end and this industry is going to survive. And it's been through very challenging lulls in the past and it's kind of pulled through. I would attribute that to the people. I think the one reason I'm still covering this industry exclusively is because I love the people. There's great people. It's infectious. It's a very global industry across so many different cultures, religions, parts of the world, different economic backdrops. It's a very interesting, diverse industry from that standpoint, and it's been very resilient. I think that's part of the reason. So I do think the industry is going to survive. I'm just encouraged of what I've seen in the last little while, just the last few months of the industry starting to take steps to kind of acknowledge that it needs to focus on marketing and come together and create demand for its products. So I think that's good. Just within the last year and a half, China's fallen off a cliff from a demand standpoint. I mean, diamond demand in China is down, it's probably down 40, 50, 60, maybe even 70%.
Wow.
Just, I would say within the last, probably 12 to 18 months. So, and
Is that
China's
because they've all sort of focused on gold? Sorry to interrupt you there. Is it?
Yeah, so I think that's part of it. I think it's a sentiment issue. I think people were locked down for, I think, a lot longer than they probably expected or were comfortable. And I think people are just feel they need to save money and they need to store savings, and they're uncomfortable maybe buying the level of say discretionary purchases that they have in the past. So I think it's more of a sentiment issue. Then you have the macroeconomic backdrop, and I think people are thinking, if I'm going to buy jewelry, gold's showed that it's going to maintain its value. I mean, gold's at all-time highs right now. Diamonds are off the highs. So excuse me, I think that's part of it. But I think it's more of a sentiment issue, and I think it's more of kind of a macro issue in China right now. So I think there will be recovery there. And even if there's a little recovery there, I think it'll be felt by the industry because it's down so much. So, I mean, you have any industry where the second largest consumer just falls off a cliff. I mean, you're going to feel it. So, I mean, I think that's a kind of a, front and center, why the industry is in this situation it is right now. I think China is a huge part of that. And if we see any recovery at all in China, and it's not just diamonds, it's like luxury. I mean, if you look at Louis Vuitton, his comments on the luxury industry and just the watch demand, secondhand watch demand out of China is down, pretty much the same level as diamonds. So it's basically across the luxury discretionary, consumer segments that we're seeing that it's not just diamonds. And I do think there will be recovery in China, and I think when we see that, I think it's gonna be quite noticeable, and you're gonna feel it with from a diamond demand standpoint. So I guess that's kind of the other thing that maybe some people have given up on China, but I don't think the industry should give up on China. I think there will be a recovery in China.
One last one from me, Paul. Are you married?
I'm not.
If you do get married and when you propose, will it be a natural diamond or a lab-grown diamond?
I mean, I think that the honest way to answer this is you should probably know who you're marrying well enough what they want.
Well handled.
But I think natural diamonds definitely resonate probably as a little bit more special for me. So if it feels up to me, I think natural's the way to go.
Yeah, nice.
There you go. Beautiful. Thanks a lot for your time, Paul. This has been hugely educational. So thanks for coming on and teaching us a bit about the diamond industry.
My pleasure. Thanks for having me.
Thank you, mate.
There we go. Did you get an answer to your lab or natural diamond ring that you're comfortable with?
Yeah, I think everyone has personal preferences, right? And it's like the way that people are going to express those personal preferences, like what's the market for each, the market size for each, and how's that market size for each going to change over time? Like I'm super interested in that. Like which other commodity or metal that is kind of produced from mining do you have such a clear transfer of consumer preferences for different prices? It's like diamonds is the most pure, for lack of a pun, kind of market where you get that. But we know a lot more about the market now, which is super helpful, and I think it'll be one that we pay closer attention to the stocks that have diamond exposure to now.
Is there any, like, and obviously because it's an allotrope of carbon, but is it similar to graphite, the diamond industry at all, from mining and the lab grown at all, without me listening to the episode yet?
Nah. There's a lot of differences. Carbon's like graphite's abundant. Diamonds are rare. Graphite requires a very long process to make, and diamonds, it's the miners often are the same person as the retailer, like De Beers in some instances too, where you wouldn't get that in the graphite industry.
Price makers.
Yeah,
very good. Mineral mining services, price maker or price taker? They probably will be price makers because they're that fucking good in the future. So all these companies will be price makers. We only take price makers as partners. Grounded Construction Group, Cross Boundary Energy, Sandvik Ground Sport. Oh, Jesus Christ, talking about a behemoth. CRE Insurance, K-Drill, DaceSat, and go bloody get down on one knee to the missus if you're feeling the need. Get a diamond ring. Hootaroo Money Miners.
Hootaroo, Matty.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.